Hello, everyone. Welcome to our webinar on the impact bad data has on a pension plan. I am Megan, PBI's Marketing Design Manager, and I will be today's moderator. During today's webinar, we will be going over industry changes and challenges, the impact missing or inaccurate personal identifiable information, which also is known as PII, and how to improve your data quality. Today, we have Mike and Geoff presenting. Mike is the Director of Operations here at PBI. He has over 15 years of experience working with data and records, and we are excited to have Geoff, the Executive Vice President of Dietrich, join us today. Geoff works directly with pension plans, retirement plan advisors, and insurance companies to provide pension plan risk advisory and insured retirement solutions that promote the financial health and effectiveness of retirement plan sponsors, the plans they manage, and the retirements they support through education, objective advice, and access to institutional solutions. So I'm going to hand over the presentation to Mike to start discussing the impact missing or inaccurate PII has on pension plans.
Great, thank you, Megan. Thank you everyone for joining us at this call. What I want to talk about is the impact that inaccurate or wrong PII has on finding a person, ways that we can kind of help clean it up. I know that the way you can get inaccurate PII can come from a lot of different reasons. One of those could just be older data, older systems that haven't been updated, can go back decades. Sometimes it's another record keeper or legacy record keeper that just didn't have the resources necessary to keep up to date with their data. And in other ways, just things happen. Typos, Scrivener errors, data gets inputted incorrectly. We've kind of seen it all. So what we want to talk about is 4 areas that have the biggest impact on locating a person in the data space, and that would be the Social Security number, the name, first and last name, primarily their date of birth, and their location. The first thing I want to talk about is the Social Security number. That's the biggest and most severe impact. The reason that's the biggest and most severe impact is we use the Social Security number along with all the other data points to verify a person's information. If we don't have a Social Security number, we don't have what is the best resource we can use to verify other data points. So if we have a Social Security number and some other data point is wrong, we can more easily clean it up. If we don't have a Social Security number, the only way we can clean up a Social Security number is if we have the proper first name, last name, date of birth, and location. And what I mean by location is usually city and state. If you have a full mailing address, street address, zip code, we'll take it. But city and state is really the key point for locations when we talk about that. When I mentioned highest likelihood of causing a missed death or not locating a person, we have seen a missing or wrong Social Security number result in 90% fewer found deaths. That's a study that we did earlier this year, and it was about 91% fewer found deaths. We are better at cleaning up Social Security numbers when they might be off by a digit or two, but when they're blank or placeholders, again, we need to get all the other data points there to help us clean up that data. So that is going to be the most severe one, and something you'll want to take a look at to make sure you have it in properly. The next one that I want to talk about is the names. This one's easier to correct. It's usually last names. If they're wrong, they are they will be maiden names or name changes after the wife has maybe remarried. Hyphenated names where you're missing, the last part of the hyphenated name. Things of that nature is usually where we see missing or last names. First names, the most likely time where we see missing or inaccurate is with a first initial, where somebody just doesn't know the full first name, or they could just have a middle name as a first name, things of that nature. We want to get that corrected, because if we're locating a person, we want to make sure that we're giving them a letter with the right name on it, so people are going to be more likely to open the letter. Or if they call in after they receive a letter, we want to make sure we're talking to the right person, not just a first initial or a misspelling on a last name. People tend to be pretty sensitive to that. And then as far as, the biggest issue we have is when somebody gives us potentially a spouse's name or a child's name and all the other data points to the participant, it's unclear to us if they actually mean the participant that they're looking to find or the child. A good example would be the participant's first name is John, the spouse's name is Susan, but you gave us John's date of birth, John's social security number, John's last name, but you gave us Susan as a first name, and we can't tell on that case. Are you really looking for Susan or are you really looking for John? And in those cases, we might ask for some clarification. But we typically can get most of those types of data cleaned up. And as you'll see on the next slide, Megan, if you can. It also has an impact on dates of birth or ages. This is also relatively easy for us to clean up. The most common issue we have here is if the date of birth is provided for a spouse or a child. We can usually clean that up if it is within a couple years, and we see that a lot with spouses. They'll give us a spouse's date of birth in 1936 when the participant was born in 1935. Again, we can clean that up. Another very common issue that we see is with the day. You have the month and the year correct, but you'll just have day as a placeholder. Again, we can clean that up relatively easily. That's kind of not as big of an issue when you're locating somebody, but if we're trying to make sure that we get somebody, if they're deceased and we can find out if they're deceased, we'll try to make sure we have the proper date of birth, because you can get mismatches on dates of birth where you're pulling in the wrong person and potentially saying somebody's deceased when they're not, if you're going off the wrong date of birth. So we would like to get that cleaned up and correct before we actually go and try to process anything. The last one and the biggest, probably least impactful, is address. The reason I say that's least impactful is it's our easiest data point to clean up if the social security number is correct, if the name is correct, and the date of birth is correct. On average, I think the average American moves about every 7 years. So it's likely that most people's databases are going to be outdated with locations. We've done a study where even if you think you have great data, you likely have about 5% of your overall data as being outdated or inaccurate or wrong. Most of that is around addresses. You could be correct on everything else, but if you haven't done an updated address in the last couple of years, chances are 3 to 4 to 5% of those people had moved in that time period. You want to get updated addresses, especially if you're trying to locate somebody, send them a letter, things of that nature. That's one's going to always kind of get updated. The other thing that, while it is easy to correct, if what we've seen is clients ask us to send out addresses or letters to their address, not necessarily the best known address, and that can be costly with the additional labor that's taken into account to send out letters to older addresses. What we've seen is a higher hit rate on more recent addresses and kind of best known addresses. We also, when we talk about cleaning up data, we will use commercial databases we have access to get the most recent and accurate location. Common misses on clients' data is apartment numbers, suite numbers, little things like that can have a big impact on getting somebody a letter, because we don't have the exact right address, especially with apartment numbers, they tend to be overlooked. And we use those commercial databases to get updated dates of birth, updated names, and really clean up that data and make sure that when we have the file and we're ready to get it moving over to getting processed, we have good, clean, accurate data. And that's all I have for my slides. Yeah. Geoff.
Thank you, Mike. All right. I'm going to jump into something a little bit more specific than just the general idea of data and more of an application of it where we see it every day. So Dietrich focuses in the pension risk transfer space. For those of you that aren't aware of what pension risk transfer is, it is settling the pension obligations from a defined benefit plan. And it's usually done in there's two methods to do it. You can do it through a lump sum settlement, which is essentially a present value of a future benefit due to a participant. A lump sum has to be affirmatively elected by a participant, and that's where data is going to come into play here. And then the second option is annuitization. It's turning the pension obligation over to an insurance company. This graph here shows the growth of pension risk transfer over the last decade. Prior to really 2012, there was about $3 billion of pension obligations transferring from employer-sponsored pension plan to insurance companies. And this shows the growth of the annuitization since 2012. 2012 was a kind of a watershed year where General Motors decided to settle about $30 billion of pension obligations. And that kind of lit the fuse for what would become a exploding market. As you can see, the last several years, and this year is expected to possibly be a record year, roughly about $30 billion of pension obligations being transferred from plan to insurance company. And that transition is for the life of the benefit. The plan sponsor is sending the benefit and the participants to the insurance company to take over the administration and funding. So having good data is important for a couple reasons. And this slide, while it doesn't show lump sum activity, I can promise you that lump sum activity has been just as impactful and from a scale perspective, more benefits settled via lump sum than annuities. So we're talking about a considerable amount of participants that are being approached either to take a lump sum offer or to be informed that their benefit is now being guaranteed by an insurance company. Next slide, please. I'm going to touch on a couple things regarding data and de-risking or pension risk transfer, both from a standpoint of the financial impact that bad data can play. So we all know that time is money. That's a pretty basic cliche that's out there, but when it comes to de-risking exercises, it really is. You have whether it's HR folks or retirement plan intermediaries working on your behalf to conduct these de-risking exercises. The worse the data, the more time is going to be spent in trying to correct that data, trying to communicate, as Mike mentioned, more mailings, more packages being printed, potential overnight mailing costs, definitely certified mailing costs. So and just your individual's time. De-risking exercises are not something that happens every day. It's not, you don't have a designated employee that is in charge of de-risking. It's something that is usually being put onto a individual or individuals within your firm, or like I said, other retirement plan intermediaries like Dietrich. And if you're taking them away from their normal jobs, there's obviously a cost associated with that. Delays, specifically within plan termination space. Plan termination is a very regulated process, regulated by the PBGC. There's certain windows within the process that you have to conduct communications and distributions of benefits. If it turns out that you go out to your participants through an initial outreach and there's a significant amount of return mail, well, that begins the delay of ultimately distributing those benefits. So going into a de-risking exercise with good data, knowing where your participants are, as simply as that, as simply as having an address so that the communications that are required to be received by your participants in a timely manner are received, helps keep the project moving along as it should. On the other end of the project, once everything is distributed, specifically in the annuitization sector, each participant receives a certificate outlining their benefit. You as the plan sponsor receive a contract from the insurance company outlining the benefits that are being distributed or now guaranteed by the insurance company. Any delays in communicating with participants through the transition is going to delay the issuance of those contractual documents. That adds confusion to the participants. It adds scrutiny to the process from a standpoint of the IRS and the PBGC, because again, there's a specific time period when these documents should be received. And I would say that data is the #1 delay for these items. So definitely time, and as I said, time is money in all of this, is a big impact of bad data. Specifically from a cost standpoint to de-risking exercises, there's a couple implications of bad data as well. Liability targets and overpayments, two separate things that we put into one line because it ran out of space. But liability targets are basically your data or your liability in a pension plan is based on date of birth of an individual, which is the life expectancy side of it, and the benefit amount. If you have bad dates of birth on individuals, spouses, beneficiaries, that will affect your liability. If you feel that somebody is a certain age and it turns out they're 10 years younger, that's going to be more of a cost to you that you were not expecting. Overpayments. So this is specific to retirees, individuals that are receiving monthly income from a pension plan, especially today in the time of direct deposit. You don't have the benefit of seeing an uncashed check like we did in the past. If an individual is deceased, they cannot cash a check. But if an individual is deceased, they can still have a bank account open and receiving direct deposit. And that leads to overpayments. We all want to believe that, you know, executors and family of a deceased pensioner are going to do the right thing and stop those benefit payments. But sometimes they're not even aware of what that is, who to contact. So doing regular death checks on your current pensioners is always a best practice. Lump sum versus annuity versus PBGC. So these are the different settlement techniques. The PBGC comes into play when there's a plan termination. If there are missing participants, individuals you cannot find, you have the option of turning them over to the PBGC. From a standpoint of the lump sum versus the annuity, there is a difference in cost of settling that liability. The lump sum in most cases can be anywhere from 10% to 40% less costly than an annuity. What that means in most clients that we work with is that the plan sponsor wants to achieve the highest potential take rate on a lump sum offer that they can, because it's going to save a meaningful amount of dollars to settle that liability. Well, if you have a bad address, you don't know where somebody is, you can't get them the lump sum package and they can't affirmatively elect it. Again, they have to elect the lump sum. If you don't know where they are, they can't elect the lump sum. That means then you either annuitize them or you turn them over to the PBGC. And in both cases, you're going to recognize, like I said, probably a premium of 110 to 140% of that lump sum figure, which can be significant. Reduced carrier pool. So you conduct your lump sum offering and then you annuitize the remaining participants. If you have missing participants, unresponsive participants, that's going to limit the number of insurance companies that will bid on your liability. Less bidding insurance companies is not just less choice on your part, but less competition and potentially more cost to the annuity. So finding your participants prior to a de-risking exercise, and then those handful that may slip through the de-risking is impactful, both tangibly to cost and intangibly based on the results that you're going to see with the carriers that are bidding on your opportunity. Last but not least, mortality. This is a relatively new occurrence. Over time, insurance companies and other data miners have become better and better at kind of guessing how long individuals are going to live. And when annuitizing your liability, that's a big part of it. It's the insurance company's assumptions based on how long are they going to have to pay a pension to this individual. It used to be as simple as, well, if it's a female pensioner, we're going to be paying that female on average 3 years longer than a male, and we'll price that accordingly. It was also as simple as, is this a blue collar or a coal miner who has a lower life expectancy than, say, a white collar engineer? Today, many insurance companies in the pension risk transfer space are looking at life expectancy on a much more granular basis, and that comes from addresses. Insurance companies look at zip codes and even the 4-digit extension at the end of a zip code to base their mortality assumptions. And whether your individual is on the good side of mortality or the bad side of mortality, having that data is going to prove to provide a lower cost to annuitize that benefit, regardless of which way the assumption goes. Insurance companies are conservative by nature. The less information they have, the more conservative they're going to be, the more costly the annuity is going to be. So whether it's finding individuals in a timely manner to keep processes moving, finding individuals to take a lump sum that is going to effectively save the plan sponsor considerable amounts of money, or having good information on your participants that you're annuitizing so that you can maximize the number of insurance companies that will bid on that opportunity, and that those insurance companies know exactly what they're dealing with and do not have to provide or build in conservative assumptions that increase the cost of the annuity, will help your ultimate cost of your de-risking exercise. So I think at this point we can open it up for questions.
Thanks, Geoff.
You're welcome, Megan.
No problem. We did get a lot of good questions, and we do have a few minutes to go over them. If we don't get to all the questions, don't worry. We will get to you after this webinar. The first question, what is the current hit rate accuracy level of the Death Master file to report deaths with 1, 3, and 6 months? I think this is a good question for Mike.
All right, thank you, Megan. This is a fantastic question. The Death Master file has about a 23% hit rate. About 90% of the deaths that we find in the Death Master file are found within the first 45 days after the date of death. Our process, though, is beyond just the scope of the Death Master file. We also have access directly to states' files, and that accounts for about 12% more of our found deaths. But the highest percentage of our found deaths are through our obituary search, which accounts for the rest of the found percentage of over 60%. As far as accuracy, we have charted the DMF at an error rate of 0.8%, or say another way, they are 99.2% accurate. Our obituary search is 0.05% error rate, or to say another way, 99.95% accurate. So Death Master file does a pretty good job of being accurate, but they don't find very many deaths when you compare it to other sources.
Sounds good, thank you. I think this next question is good for Geoff to answer. What are the best metrics to use to demonstrate data quality improvements over time, and what matters most to measure?
Yeah, specifically as in our space, matters most is accurate dates of birth, accurate addresses, and one thing that I didn't mention earlier is Social Security numbers. Mike brought it up, and I think Social Security numbers are the key to everything. Insurance companies need that to keep tabs on the individuals and track the death. So I think that I didn't mention it, and Mike did. I think that's probably the most important metric because that's the key to finding someone.
Perfect. Geoff, this is another good question that I think you can answer. Do you use professional services that provide current addresses and other vital stat information?
Yeah, that's a layup. That's PBI. We use PBI to help with our smaller clients that don't have the death tracking and address search capabilities, and then any of our larger clients who are looking for an outlet who maybe their trustees don't provide death tracking and address searches. We refer PBI. So you do an excellent job.
Thank you. This next question's for Mike. Has any clear information been provided as the frequency of participant searches?
Yes, I believe this question is referencing the guidance provided by the Department of Labor in January of this year. And my suggestion is for each company to take a look and read, interpret that guidance, and how they best see fit to reach out to their own participants. But it should be within that guidance.
Yeah, I will add that the PBGC, well, the DOL, updated it earlier this year, and the PBGC has become more stringent on what a plan sponsor must do to certify that a participant is missing. So that's important from a regulatory standpoint too.
Great, thank you. Geoff, this question is probably good for you. How much impact does spouse data have? Are death searches for the J and S spouses worth the effort?
Spouse data, yes, that's a good question. Again, this is more on the annuity side of de-risking, but it's the idea of you don't want to pay benefits out to deceased people. So when you have a joint benefit where you're paying your participant and that benefit continues on to a spouse or a beneficiary after the death of the participant, and you go to annuitize that benefit, chances are you don't know if that spouse or beneficiary is alive. Chances are you may not have a social security number or even a name for that spouse or beneficiary. And it's very important in your setup for de-risking or in your day-to-day data management to have that information, because you run the risk of annuitizing somebody that's not alive. And again, there's an additional cost associated with that, or said the other way around. If you find out that that benefit is no longer a joint benefit because the spouse is deceased, there could be a considerable savings in annuitizing and settling that benefit. So very important to look at spouses and joint benefits as well.
Perfect, thanks, Geoff. We got one more question, time for one more question that just came in. Do insurance companies achieve a stream of payments or lump sum values?
Say that again. Do insurance companies a sheet? Is that
Yep.
what it?
A stream of payments or lump sum values.
Yes. So my guess is that this question's regarding a missing participant or a participant that goes missing when with an insurance company. Outside of a firm like PBI, who is in the business of finding people, insurance companies are equally excellent at finding people. So it's rare that a benefit would need to be sheeted. Also, like I mentioned earlier, there's a handful of insurance companies that don't take missing participants for that reason. They don't want to go through the process of a sheetment. But yes, if it turns out that a participant is missing and the benefit can't be paid, it will ultimately be sheeted, and that is based on state requirements surrounding a sheetment. So whether it's a lump sum or a series of payments would be based on the regulations in place.
Great, thank you. Thank you, Geoff. Thank you, Mike, and thank you everyone who attended today. Our time is up. If we didn't get to your question, we will contact you after this webinar. And if you have any questions, feel free to reach out to Mike, Geoff, or PBI, or just reply to the webinar invite, and we will get back to you. We will give you the recording link within the next 24 hours. So thank you again for joining us, and have a fantastic rest of your day.